Hey everybody, this is Tim Picciott, the Liberty Advisor, joined with John Sneisen, the economictruth.org, which is where you can find him. And we are today going to talk about the Fed support of junk bonds is like putting lipstick on a pig. Also wanted to acknowledge that today Luke Rudowski is taking a much-needed day off. So hopefully maybe Luke can go and find some masks that he's looking for. So just kidding, Luke, we love you. But what we've got going on today is the Fed's leave no asset behind set of actions is holding up the corporate bond and other markets. In an unprecedented move, the Fed created special purpose entities to buy exchange-traded funds, or otherwise known as ETFs, such as LQD, JNK, which is, junk, so that's kind of funny, and then HYG, which probably stands for high yield something. And I think maybe that last one might even be owned by BlackRock. I'm not sure about that. But anyways, I'm not making any recommendations to buy these. It's just because they are in the news. And so what this means is you literally have the Federal Reserve buying up junk bond assets, which this is completely, unprecedented. What do you make of this, John, with the Fed, coming in here and completely distorting the markets?
Well, actually, what's fun is actually really not the Fed, but the Fed and the Treasury is not married, so it doesn't matter. But it's actually the Exchange Stabilization Fund, which is a fund that is run by the Treasury that is, funneling all this money. So I'll be very interested to see their consolidated financial statements for this month coming up right away, actually. So I can't wait to look and see what that will look like, because that's what they're using, a slush fund that they actually, came about from the stolen $2 billion from the gold confiscation back in the 30s. And he also did the same fund rated off, of course, back in the day. So it's very, very interesting how they're using that fund, of course, which is, flushed with with currency. And it also holds the SDRs, the special drawing rights, the IMF currency. But, it's funny. They're trying to desperately, cover over these junk markets. And of course, back in my 2020 risk report that I, published back in January, I warned about this. Like these junk bonds, all these mass amounts of junk bonds, like it was 78% issued in 2018 was junk, and who knows about, in 2019, it probably were more like 80-something%, right? And it's coming apart now. You can't put lipstick on a pig. And actually talking about that should transition us into the next article, which is, of course, another pig.
Let's also not forget that now, the pigs, a lot of them, there's 100-foot piles of dead pigs because the entire, supply chain is completely broken down. So and then that saying also does come from when Obama said at a campaign event that you can put lipstick on a pig, but it's still a pig. And then, so sorry about that, John.
Yeah, well, you can't put lipstick on Italy's economy because it's terrible. And it's, of course, one of the pigs countries, which is Portugal, Italy,
Greece.
And Spain and Greece, of course. And, they just actually got downgraded by Fitch to triple B minus, which is right above junk. And to explain that, like the whole thing about being, non-junk and below junk is being either investment grade or non-investment grade. And if you actually do drop the low non-investment grade into non-investment grade, you basically are not eligible for mass amounts of money in pension funds and around the world, right? And sovereign wealth funds and so on. So basically you lose out on the total economy. Like South Africa just, jumped below as well. So you're seeing a lot of the periphery economies. And of course, I believe Italy is the third biggest economy in Europe. And you have that, that whole sector. Me and Josh have reported on this for so many years now. With, Intesa Sao Paulo, you got, what do you got there? Actually, I have it up behind me. You got Banco Generali, Banco Popolare, Unicredit. All these Italian banks are in such terrible shapes, and they've been bailed out forever by actually, and they've used, the German banks like Commerzbank and Deutsche Bank. They also used, what is it called, Societe Generale, SocGen as it's known as well, to actually bail out those southern economies that are doing in such horrible shape and mass bureaucracies. That's what collapses an economy, is when the government is bigger than the economy itself, right, Tim?
Yeah, no, absolutely. And one of the other things, I do want to, point out is basically the premiums that people right now are paying for these junk bonds are nowhere near, commensurate with the amount of risks that people are taking on. And so you're getting, a lot of the optimism that was going on in the stock market is the same thing that you're seeing bleeding over into the bond market. So if you pull this up on screen right now, you see Boeing debt explodes after sale of $25 billion in massively oversubscribed junk-like bonds. And so, you've got, a company like Boeing that, in the foreseeable future, it looks like people aren't even really traveling anymore. If they, then they were already mired in problems before all this stuff happened with their, what was it, the 737 Supermax or something like that?
Yeah, the Max, that two of them crashed because of computer programming that actually told the plane how to fly because they couldn't fly properly the way it was built.
Maybe they should have
because they didn't share buybacks. They didn't do research and development properly, right? They spent all the money on buying bonds, their own stocks through share buybacks and use it.
Yeah, and if it didn't have so many, crazy implications, this it might actually be funny. But the bond market has not been overcome by this. The bond market hasn't been overcome by the same optimism as stocks. And basically, what's going on is that the logic for this call is that the incoming economic data will continue to be ignored in favor of headlines regarding the treatment of COVID-19 and success of the reopening efforts, which will commence in its earnest during the second half. So basically, people are like, oh, well, there's going to be some new vaccine or there's going to be soon some new wonder drug. And so we don't need to actually worry about what the actual fundamentals are, what is actually going on with the company, because they might be getting free money and maybe they can start getting, using that money to buy back their own stocks. Even worse than Boeing was the airline industry in general, which used 96% of their free cash flow to buy back their own stock. Sorry, I think it was to the tune of like $46 billion over the last 10 years. And now we've only had, and then now they're asking for a bailout of $50 billion. And I also do want to point out, if you guys are watching this on Change the News, definitely appreciate that. We also filmed a Tim and John show, episode number 9. We filmed probably about 30 or 40 together, but the official, those were prequels. This official one was number 9, and we got into some pretty interesting stuff. At least if you like economic geek stuff, but that one went almost an hour, and we talked about, what did we talk about? We talked about how, what happens if we end up defaulting on the debt to China, whether or not China caused this or not, that, that's probably could spark a whole nother debate. And then we also talked about how the largest gold dealer in the world is shutting down their operations, and that was Scotiabank.
Scotiabank, yeah.
Yeah, so we have a lot of stuff to talk about in that, but that is on my channel at Tim Show with the Liberty Advisor. So if you guys want to go give me some love over there, and John and I some love on that, it would be awesome. But anyways, getting back to some of these articles over here, it says, don't be fooled, a 40% drop could hit by next year after this bear market rally fades. Veteran economist warns. And so by veteran economists, they are referring to Gary Schilling. And I took it off the screen so that way I didn't drive you guys nuts when I flipped things up and down. But Schilling, he was known for, predicting the housing crash. Now he did have something called, I wish I had pulled up, and I've mentioned this in several presentations, was called the CAPE ratio. So that is the cyclically adjusted price to earnings ratio. And so basically what that means, long story short, is the higher it is, the more overvalued stocks are, but on a longer time horizon. So what this measure was really good for is when stocks were valued like in I believe it was the top quintile of being expensive, so the top 20% of being expensive, which is where we've been camping out for the past several years. That basically what that was looking like is and I don't have the exact numbers right in front of me, but it was something like if you were in that top quintile being expensive on a forward 10-year return, the stock market return was something very, very low. We're talking like in the 3 to 4% range. And this is a message I've been telling people forever. And when I say 3 to 4%, I don't mean like, oh, it means the market's going to go up 3 to 4% a year. It's going to mean, okay, well, it went up way too much, the past, 5, 6, 7, 10 years. And then now what we've seen is that, plummet back down to reality, and now boom, right back up to these way overinflated numbers. And I don't really know any asset managers worth their salt that are coming in here and trying to buy into stocks at this level. I don't have the Dow in front of me, but I think earlier today it was like at 24,333. And so going to Schilling over here, his I just love people, this guy's a shill. So Wall Street rallies on hopes the worst of the coronavirus outbreak is over. To me, it's like 1929 when stocks first fell, then rallied before plunging anew as the Great Depression set in. the damage worldwide economies is yet to unfold as stocks will collapse to new lows. And maybe one thing that John can maybe talk about is, in 1929, there's a lot of things that they did when FDR ended up getting elected. I don't know if he was I think he came like a little bit later, like a year or two later. But he's always credited for saving America for the Great Depression. Now, do you have any thoughts on that, or when government actions coming to save the day, John?
Well, the government is just plowing money in and building, roads everywhere. Of course, yeah, some little good things there, of course, with the highway system and everything. But other than that, like the government spending a whole bunch of money, it's misuse of that and all that. And of course, like the government coming in and intervening, just really prolongs the crisis at hand. Of course, when you have intervention.
Yeah, so we're going back, to the articles, and what it was saying is that basically Schilling pointed out that there was a 48% plunge in the Dow Jones in 1929 from September 3rd to November 13th. So, actually the plunge we had now was even quicker, faster. Something like a Kanye West song, like bigger, faster, stronger, louder. But no one wants to hear me sing. And one of the reasons for that, in my opinion, is all the ETFs. We did a video on this. I don't know if it was a Tim and John. It was one of the Tim and John shows way back, a prequel show where we talked about a catalyst for a downturn would be the proliferance of ETFs, these exchange traded funds, because people are just they're throwing money into these funds, they're throwing money into the S&P 500, throwing money into the Dow Jones, and then indiscriminately, they're not looking at companies' balance sheets. And when they do that, what ends up happening is that, it's great when on the way up, but on the way down, it also exacerbates it. But, don't worry, the Federal Reserve comes in and is, making things even worse by just exacerbating this problem and bailing out, the richest people in the world and not bailing out, Main Street. And, I'm going to skip to this article right now because speaking of Main Street, the PPP problems, the Fed just expanded its Main Street lending program. Here's what businesses should know. So, it's glad that they, decided to get around to expanding this program because, we had to, of course, this had to be done after all the big companies and the banks and politicians and everybody else gets bailed out and municipalities. And, last down on the line of things is small business owners, which is the, heartbeat of America. But, as, we got guys like Gary Schilling, talking about how the Dow, and actually, let me just go back to this article because what it was saying is, so buyers stepped in, they pushed stocks up 48% through April 17th, 1930. Then, so that was a 52% retracement. And then the bull times, he wrote, didn't last long as the Dow ultimately shed 89%.
Yeah, sounds like the general public coming in and buying stocks now on a big scale.
Yeah, and you didn't even know that the very next article I was going to show up here was poor decisions galore as newbie millennial / Gen Xers pour into expensive stock market. And you see the amount of TD Ameritrade daily average client trades. And so TD did cut trades, the fees down to zero. And now you've seen this absolutely explode in the amount of trading, which I will say as a financial advisor is not the best thing to be doing, especially if you don't know what you're doing, to be constantly trading these markets. Now, if you're a trader and you know what you're doing, you're reading charts and you got a good handle and you got extra money to waste and, to speculate, then that's one thing. But one thing that sort of struck me from this article, and for some reason my highlighter doesn't work on Zero Hedge, but this is reading a quote here. It says, I feel like everything that I buy, I watch pretty closely. And if it's something that's not doing well, I'll generally try to put that money into something that is doing well instead, he said. Working from home, he added, has allowed him to watch for movements more easily. Now, I mean, technically, that's pretty much the exact opposite of what you should be doing as an investor. I mean, not giving investment advice up here. But what you should be doing is if you own something and it goes down, you should want to buy more of it. Like if you're right now, Bitcoin's at 8,600. If it goes down to 5,000, if I like Bitcoin, I should want to buy more of it. If it goes down to 2,000, I should want to buy more of it. And then it's to say I'm putting in $500 a month. Well, now through dollar cost averaging, I'm buying more and more and more and more. And so if something goes down, you're like, oh, well, I'm just going to get rid of it and go get something that's up. You're actually better off like just buy. I mean, I think it's called the dogs of the Dow theory, where you just go in, you just put all the money in like the worst performing things that did last year in the Dow, and then your portfolio will be way higher. So that it's a contrarian approach, past performance notification of future returns, blah, 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 blah. But, the average person doesn't realize this. And they don't necessarily know these things, and so it's seeing people getting into this market at the exact wrong time. Is very, very telling. And I think one of the things I wanted to kind of address right now is inflation or deflation. This is Miss Shedlock warns that demand collapse trumps supply shock. So a lot of our viewers especially, those of us who know us from the World Alternative Media days and know us, maybe from Tim and John's show previously. A lot of them think that, we're in store for this like massive hyperinflation that was going to happen, 2 months ago. And where I was calling for the dollar to get stronger, not because I like what's going on or endorse what's going on, it's that people flee to safety assets, which right now they view the dollar as being, that quote unquote, safe asset. And so, I do sort of, agree with, and this is something that we did talk, I think in the previous Tim and John show with Kirk Chisholm about, so I don't want to belabor that point too much. You guys can go check out my YouTube channel, Tim and Show with the Liberty Advisor, and catch that. And then now we've got an article, will Airbnb's implosion trigger a housing bust? So I don't know, do you want to take this one on, John?
Well, that's the problem, is that all these Airbnbs are just owned by people that, suddenly became landlords. They just bought up a whole bunch of real estate and then renting it out. They're just turning it around and renting it out through Airbnb, right? So it was pretty easy. But as the economy has slowed to a complete halt, there's nobody using those Airbnbs, and that mass amounts of real estate that they're holding with all the debt on it. Now they're going to have severe problems actually paying that debt back, and that's going to be a huge implosion of, especially in North America. It's going to be the greatest ever, implosion that we ever have seen on the housing. It puts a huge strain on the market itself. Meanwhile, you have active listings versus host, and of course, it's just going through the roof, as there's nobody that actually are able to buy in and actually travel anywhere right now. And somebody's talking about, travel's going the next 6 months. It's not going to happen, most likely. So you're seeing, the economy is in a basically lockdown, and nobody's able to do it. Well, going to have several severe implications there. When it comes to the Airbnb market and what they are doing, especially where they're heavily situated. I haven't looked at the stats or anything, but I would assume, it's in, the nicer vacation kind of areas where people like to go, of course. And that's going to, have a heavy tank on the real estate prices. And then, we have the whole cycle where, you're underwater. Basically, you're down 50% of the value of your home, and
well, these guys all got over leveraged. Yeah. It was so easy for them to, hey, we're making money hand over fist. We use that payment to then buy something else. And then, they're way over leveraged. And next thing you know, everyone's, forced not to travel. They don't have money to travel. They just lost their jobs. And it's just like the ultimate, cascading effect of what's going to happen. And this is going to bleed over to several other areas, especially, like the CLOs that we were talking about back when everything was starting to blow up at the end of February. And then, going to like, Bank of International Settlements, they were having emergency meetings on CLOs, not on, everything else that was going on, not on the coronavirus. But, I think that's probably a good place to leave it for today. I also want to point out that yesterday in the second video, it's titled Mask or No Mask, Luke and I, towards the end of it, like the last 15 minutes, really got into, somewhat heated debate. So that video did not get a lot of play, did not get a lot of traction. So that's one of the ones that, especially like the back half of that is, pretty interesting. We probably should have just chopped up in the two now that I think about it. Then also on my channel, by the time this is out, we will be dropping Tim and John show number 9, even though it's like our probably 30th or 40th one. But, highly recommend you guys check that out, especially if you're into gold, especially if you want to, if it's sexy topic to talk about. I mean, if you're still listening at this point, you're probably into what we're saying. But John, we'll let people know where they can find you and maybe some things you got going on.
Yeah, no, you can find me at theeconomictruth.org. That's basically where I have everything that I do and what I'm about. And you could, contact me through that medium. Of course, you can find my books there, my reports that I put out, everything. And then, of course, you got to check out bankrun.org, where actually one of the best videos that we've done here at Change the News was the Bankrun video, where we basically talked about what I was doing with bankrun.org and how, bank runs can spread around the world pretty quickly. So, yeah, you can check those out, and that it greatly helps me because I have a full-time job. I'm not as lucky as Luke and Tim and others. So like I still rely on that, but I really want to transition over time, of course.
I also have a full-time job. So
Yeah.
I can work any 18 hours a day that I want. So, it's pretty nice. But yeah, also you check out our Discord. So John is super active on our Discord. It's bit.ly. So it's a bit.ly link. So bit.ly/Tim John Discord for all the economic geek stuff that you guys could want and possibly more. And anyways, thank you for joining us, John. Always a pleasure talking with you. And until next time, it's Tippett Show and John Sneisen signing off for Change the News.